Welcome to this edition of Thoughts from the Big Chair, a podcast interviewing senior leaders with unique perspectives on the opportunities and challenges of digital transformation. And it covers a broad range of topics from strategy to technology to leadership, and we try and cram all of that in within 30 minutes. And today we're joined by Nikhil Nath, the CEO of Knowcross, a leading hotel management software business. And good morning, Nikhil.
Good morning, Russell. Thank you for having me on the show. It's a pleasure to be here. And I'm hoping I can share some insights that are useful for your listeners today.
I'm almost certain that's true. So, well, let's kick off. And you give us a bit of background on Knowcross rather. I know you've been CEO for quite some time. Tell us about the business and how it's evolved, particularly over the last few years.
Sure. So Knowcross is a hotel software suite of products. So what I mean by that is we've got multiple products, all of which, of course, talk to each other, and they're all collectively focused on on what we call hotel operations, and it's mostly in the rooms division of hotels. So for anyone who understands hotels, that encompasses the front office, that encompasses engineering and maintenance and housekeeping. We do very little for the F&B and banqueting parts of the hotel business or for the hotel operation. So we focus sort of on some of the core areas, and we've got a suite of products that do that. The business was founded in the early 2000s. We've grown organically. Since then, we sort of raised a small round of angel money at some point, and then bought out our angels at another point in history. And so the business continues to be was tightly held, and as we discussed earlier, we went through a transaction recently, which we can talk about later. Our market is global. We serve customers in about 45 odd countries across different types of hotels, but I'd say predominantly in the 4-star and 5-star segment. We started the business way back in the 2000s as a sort of traditional enterprise software with very much the sort of client server sort of architecture. And of course, about 10 years ago, we started moving to the cloud, and it's sort of completely cloud delivered at this point. So in that sense, you could call it a SaaS business or an enterprise SaaS business.
Yeah, and we'll come back to that shortly, because I think one of the aspects I'd love to dive into is about that SaaS and that enterprise SaaS model. But I think the obvious impact over the last couple of years has obviously been COVID. So useful to understand, particularly your industry that obviously got hit quite heavily by COVID, how you've adapted your business model over the last couple of years.
Yeah, so obviously COVID took us all by surprise when COVID started, or when it started impacting business last March, and it looked like the world was going into lockdown. We sort of, we predicted doom for hotels and obviously predicted doom for ourselves. It turned out a little bit differently. And what actually happened during COVID, of course, after the initial lockdowns were over, and then the summer sort of, most countries enjoyed a sort of fairly decent summer and return of leisure travel through the summer. What happened was, I think that hotels realized that, or saw two strong trends, if you will. One, that occupancy and the kind of long run through 2010 to 2020 that they saw of high occupancies and high rates, that everything in the world is cyclical and it's not here to last. So I think that was a wake-up call for the industry. And the second thing they realized was that their staffing model is sort of broken, right? So the staffing model was relying just structurally on a lot of low-level staff who could be, serving other industries and finding jobs elsewhere. And in boom years, it was all fine. I think hotels were able to hire, they were able to pay decently to attract staff. But as soon as you have a correction like this, one of the things they realized was that actually staff, are sort of headed very quickly exit the industry. And so when furloughs happened and so on, staff started to leave the industry, and some of those staff are actually never coming back into the industry again. And so one of the things that hotels realized was that they would have to have a business model that sort of and an operating model that works with much less staffing and kind of as a percentage of guests or percentage of rooms, lower levels of staffing than historically they've been used to. And so inadvertently, it actually created a strong demand for all operations tech that was directly targeting productivity and efficiency in different departments. And that's where we benefited, because that's exactly what we do, whether we do it for housekeeping or maintenance or various other parts of the operation. So COVID impacted us in that sense, sort of positively. Obviously, hotels have had a terrible year from a financial perspective. So we had to, we were impacted as well. We had to give rebates, had to give suspensions for certain periods to those of our customers who were on contract, but was simply sort of shut down or not able to operate. So of course, all of those things happened. But at the same time, we did end up adding a number of customers through COVID, and we also ended up implementing a lot of customers through COVID, which was sort of, which is sort of hard to think about, especially when hotels are closed. But one of the things that a lot of hotels did was they used the downtimes to redo processes in the hotels, in their hotels. They used the downtime to retrain employees. And so one of the things that we ended up seeing as a fairly secular trend throughout last year and even through the first half of this year is hotels doing that consistently. And a lot of hotels who had not implemented the software, had purchased it, but were just looking for a good time to get it done, got it implemented. And the biggest change that happened actually was that earlier we lived in a paradigm where hoteliers would want our consultants to fly to the site, to handhold them, to train them properly, then walk the floors with them for a few days and just make sure the software was working fine and they were doing everything that they were supposed to do and using it well. And that has completely shifted over the past 12 months into a paradigm where hotels were actually absolutely fine with us teaching them stuff on Zoom. Obviously, we got very well organized around how to do remote trainings and how to bring them up to speed, but it actually ended up working. And I actually think there's no going back. So I think what's going to happen is there'll be certain customers who want us to come in for a few days to sort of possibly spend time with their senior teams or debate and discuss how the processes will work when the software is implemented. But the nitty-gritty of training, which is the stuff that takes the most number of days or hours, that stuff is going to get remote. And I think in due course, it'll get very automated as well, in terms of there'll be ready-made sessions, which people will enroll in. There'll be online certifications. And our trainers will sort of add to that, but in a lighter touch sort of way.
Interesting. And the way in which you've delivered the model from a software perspective, you're going back 10 years ago, you've obviously gone through a fairly significant transition, and you mentioned SaaS a minute ago. Help us understand a bit more about how you've moved to the cloud and how you've used the SaaS enterprise model, and perhaps draw some parallels between what you understand to be kind of normal SaaS for an earlier stage business versus the enterprise SaaS, which has some significant differences.
Yes, if we look back, right, it's not that long ago, pre-AWS, before cloud became, as ubiquitous a term as it is today. Software was about CD-ROMs or DVDs and servers and server rooms and all the networking and complexity associated with managing that infrastructure in most businesses, no matter what industry you looked in. And so when we came into this, when we started the business, that's what it was about. Hotels would have server rooms and IT teams, and we would have to go set up our server and install the software. And then, of course, do all the things after that to train and connect the software to their network and connect it to other systems and so on. And that's, and the pricing model was also quite different, actually. If you remember, mostly software at that time used to be a lump sum payment, and then you would charge sort of an ongoing fee for maintenance and upgrades and retrainings and things like that. We started to see the shift in the late 2000s, but we made the move to SaaS pricing actually before we actually made the move to deploying our software on a SaaS type model. So from a SaaS pricing point of view, what I mean is we realized that customers don't always do their math quite well, and also they have their own constraints from the point of view of who's giving approvals, what kind of approvals they're able to give, um, what their risk appetite is, if you will, from a software buying point of view. And one of the things that we realized was that there's sort of almost an arbitrage opportunity well before SaaS became a buzzword, um, to sort of in being able to sell our software on a pay-per-use basis rather than an upfront cost basis. And if somebody were to do the math, depending on which hotel were in the world and what the pricing was, but mostly at the 3-year mark, those lines would cross. So if we were willing to bet that a customer is going to stick with us for longer than 3 years, then theoretically we're in the money. And so we took a very bold decision as a small company to say we're going to change our pricing. It's coming, it's going to happen sooner or later. We may as well be a front runner. So back in 2010, we did that change. And then it was only a year or a year and a half after that that we actually had a SaaS version of our software ready and started deploying that off AWS and serving that off AWS to our customers. So, we sort of went in 2 stages. And it's almost hard, it's almost impossible to imagine how we were running the business and how our economics were working pre-SaaS. Of course, when we made the transition, it was a fairly sudden drop in cash flow, but we were able to sort of live through that little dip cycle before the cash flows sort of went up. But one of the things that happens with regular cash flows from a SaaS business is it actually gives you a higher gross margin if you've got it structured right. And it also gives you sort of the reliability of recurring cash flows, which is really helpful when you're trying to grow the business. And then in the last 5 years, I think there are some other things that let's put it this way, we became a little bit more sophisticated about running the business. Of course, as so many thousands or millions of SaaS businesses, came up across the world, SaaS became an industry, and there was a lot to learn from others, and some learnings sort of that we realized ourselves. So one of the things that we realized was that in running a SaaS business, a cost of customer acquisition is very important. If there's a lot of companies that have large amounts of funding at a very early stage in their life cycle, but their customer acquisition costs are sort of so high that you almost need to have a customer sort of engaged for 5 years or 7 years before you're going to be able to recoup that and actually have net profit, after taking out the cost of acquisition. And I think in our business, we were very worried about those kind of economics, and our business was not PE or VC funded. So we had to make sure that these numbers worked. And so our number actually has always been around the 9-month mark. And then we started to pay attention to that number. So we were very careful with where we were spending marketing dollars, where we were spending our sales money, and making sure that that number sort of came in at a level where we felt comfortable. And it did vary by geography. So in certain geographies where sales costs were higher, people costs were higher, the number would be a little bit higher, and in others it would be a little lower. But blended across all geographies in the world, we came in sort of around the 9-month mark, and that was quite important for us. The other sort of, the other flip side to that, of course, is what I mentioned before, which is life expectancy. And one of the nice things about being in enterprise software and being quite deep into one vertical is you sort of have an automatic moat around the business when you interface to a lot of other things in the client environment. So our software interfaces to a bunch of other systems which are critical to the client's operations. And by having those interfaces and focusing on those interfaces and developing more and more of a library of those interfaces over time, we sort of end up creating a protective moat around the business. The other moat, of course, is habit. One of the things that you don't get if you're in a sort of consumer type business sometimes is that customers can switch easily. I think the switching costs for enterprises tend to be high, and very much thinking from a SaaS provider's point of view, if you were designing a SaaS business and the business model as well as the product, one of the things you've got to keep in mind is what is the stickiness and also what's the moat, right, around the business. And if you are serving the needs of the customers and particularly the users really well, keeping your ear to the ground from a features perspective, that everything that they want to do, the system actually is letting them do, then you're also creating habit. And in enterprises, unless something is broken, people really don't want to go switching softwares, right? There's a very high change cost that's associated with that. So for us, lifetime expectancy is important. Our churn rates historically have been under 10%, and in the last few years, they came down under 5%. And I think by SaaS standards, those are very good numbers, but by enterprise software standards, they're decent numbers. They're not the best. And we'd like them to be even better. So of course, there's going to be some natural churn every year, which you can't avoid because hotels shut down, they get reflagged, certain things change. But beyond that, we don't want anyone to go away from the software because the software didn't work for them anymore, either from a product perspective or a pricing perspective. And then the other thing to obviously pay attention to is your gross margin. So again, I think when we were novices at the business, at the cloud part of the business, i.e. serving the software off the cloud, our software, to be honest, was really not designed for the cloud. It was not really multi-tenanted. It was not really microservices, et cetera, all stuff that people talk about today as pretty normal stuff. But we sort of evolved into getting here through sort of, after making a number of mistakes. And the biggest mistake was we essentially did a copy paste of our enterprise or of our client server architecture onto AWS. And that made our AWS fairly heavy and fairly expensive. So in the initial years, our cost of our gross margin was actually not that great because we were spending far too much money on the hosting. Eventually, we got that right. And today, that's again a number that we monitor very closely. So I'd say that's very important for any business to watch. And then the final thing is SaaS revenue, right? So one of the things that we've become smarter about is, again, what I call sort of revenue management, if you will, in our business. And starting to think about how do you price, what really contributes to your margins, what contributes, what are a customer's sort of boundary lines, if you will, from a sign-off perspective. So in hotels, hotel managers have authority to sign to a certain number of dollars per year, for example. And then they've got to go to corporate office to seek approval for sort of larger amounts and so on. And I think, in order to speed up the sale, in order to make sure that customers get activated quickly, we've got to do that balancing act and sort of review that equation frequently. One of the things we realized was that SaaS revenues matter a lot more than services revenues, and customer longevity, i.e. lifetime expectancy, matters a lot. So as long as our gross margin is right, it is important for us to get a customer live quickly, because any dollars earned per month, for example, when they're not live, are dollars we're never going to see again, right, if they're not live. So we want to make sure that they get activated quickly. And of course, customers have budget constraints. So if our services are proving to be a hindrance, we sort of try and optimize that around the customer's constraints, and realizing full well that services is a one-off revenue stream for us. It's not meaningful in the grand scheme of things from a enterprise value point of view, or from a creating a large ARR book point of view. And so let's focus on the software recurring revenue. And that was, again, something we got to. Again, it's, I think, standard playbook for any SaaS business today, but something I think we learned by doing. Finally, I think the other big change that's happened in our business is sort of, again, learning what matters to us from a customer perspective, i.e. asking ourselves the question as to who is our customer. And it's, in the early days, it was everybody's our customer, right? Anybody who's willing to sign a check for us is our customer. It doesn't matter who they are. I think as we grew, we realized that not every customer is the same, and we have to be a little bit more clear in our own heads as to who we want as a customer and who we don't. And let's not waste our time going after customers that we don't want. So customers who, for example, pay us very little, but put a lot of support cost and need a lot of services support from our teams. Well, that's not going to work as a long-term business model. So if we are going to charge a certain number of dollars, what's that minimum number of dollars per year that we need to charge in order to provide a certain portfolio of services, whether it be 24/7 support or immediate training for any new employee who joins or whatever. And that we can do all of that if a customer is paying us a certain amount per year. So I think we set some thresholds a few years ago for our sales teams, that a customer that you're going to chase is a customer that is going to give you a certain ARR per year. across their properties. It doesn't matter if it's one or more properties, as long as that there's a minimum ARR. And of course, that doesn't mean we don't take inbound, but if it's inbound, of course, we'll do it. But we're not going to spend expensive sales time or sales and marketing time on customers that don't really sort of, that don't meet our criteria. So that was, again, a big learning for us.
Yeah, well, some fantastic insights there on, and in many ways drawing out some of the differences between the, if you like, more B2C SaaS-based models and the enterprise SaaS market, which hopefully that was useful to a number of businesses that are looking at the lens of SaaS through an enterprise perspective. So thank you for sharing that. One of the things which certainly in the hotel industry, you can draw some interesting innovation ideas by using sensors and IoT technology. And IoT has become a bit of a buzzword, which may have got ahead of itself at the moment. But how are sensors, IoT, and kind of general innovation changing how you're going to market and what customers need?
So we have an interesting product which we actually launched during COVID. It had been coming before that, but we just didn't get it over the line. And it's a preventive maintenance product. And like any building facility or piece of real estate, right, there's a lot of preventive maintenance work that needs to be very well organized and implemented. And interestingly, hotels sort of found themselves struggling with this, historically, or have always struggled with it. And it's been a combination of sort of things written in notebooks, maybe somewhere on a whiteboard, maybe some random Excel sheets. And it's surprising because you'd think that a large multi-million-dollar facility would have this better organized, but they didn't, because they sort of fell between, they weren't large enough to afford the kind of systems that go into manufacturing, but they cost a lot and they are expensive to implement and support. And then there's the Excel sheet version of it, and hotels were sort of, always struggled therefore because they simply couldn't spend those many dollars that manufacturing can on something like it. So we'd always known this, and we launched our software. And one of the main things we did in we call it no maintenance. In no maintenance is we've actually set it up at the back end to be able to get the IoT data as IoT sensors start to get deployed in hotels. To be honest with you, like you mentioned, there's not that much IoT that's in there just yet, but it's fairly obvious it's coming. And if you think about it, there's different types of IoT. Again, you can get as sophisticated as you want, but if you imagine that you wanted to measure, for example, the flow through water pipes, well, in an existing building, you're not exactly going to open up those pipes and install those sensors unless there's a very large ROI for undertaking that work. However, in newer builds, you can expect some of that stuff starting to come in now, and we are starting to see it. So what we expect is over the next 5 years, IoT will become more prevalent in all real estate. And there's a lot of companies serving that market already. And we will be the system that will then pick up the data from various types of sensors and automatically create the workflows that are necessary to sort of act on that data. So for example, if you find that a certain part of the hotel is much warmer or certain rooms are not at the ambient temperature when guests are in there, we know there's something wrong with the chiller units or with some other part of the air conditioning system that's operating on those floors or in that area. And we flag that up. We automatically execute an inspection or an audit or a preventive maintenance job for that area and for those specific units if they're mapped in the system. So I do see it coming, but again, I think the noise is a little bit ahead of the reality right now, but it doesn't mean it's not going to come. There's a lot of efficiency that IoT adds in the business, and we do see it coming in a big ways, if not over the next 5, but certainly over the next 10 years.
Yeah, and I think it's one of those things, isn't it, where the cost of sensors, and with 5G now starting to make connectivity reliable, it's the trend is obviously going in a direction of greater adoption. But as you say, when it comes to existing infrastructure, the ability to retrofit it is then going to be very much of a case of where's the ROI for customers going forward.
Yes, exactly. And customers, again, I think coming out of COVID, that may even push it back a few years, right? I mean, hotels are not in the best state financially, and it'll take them a few years of normal business to sort of start, get their balance sheets back to a sort of healthy level before they will consider investments. And that's an interesting point, actually. I think a lot of investments in redoing hotel buildings, in revamping operations, or let's say if somebody was considering adding 100 rooms to their hotel or something like that, I think a lot of those would have got kicked down the road because of COVID.
Yeah, very good point. Just now, finally, I know that over the last couple of weeks, Knowcross was acquired by Unifocus. Tell us a bit about that and what insights you drew from that experience, because I'm sure a lot of people listening have a business which they may be considering raising capital or selling the business, and you've obviously been through that process, and just wondered whether you had any insights for folk that may be in a similar situation.
So before COVID hit, we were considering a transaction, and the reason for us to look at a transaction of any kind actually was that we realized that there's technology is a competitive space. There's a lot of capital that comes into technology businesses, especially at early stages, and then if they do well at later stages. That capital is cheap, it's plentiful, and there's a lot of good capital, i.e. with people who know how to build software businesses, that's around to be deployed. And so as a vertical player in a part of the vertical industry that we serve, I think we had to sort of take a call as to, do we want to keep growing the business organically, or do we need capital to make sure we stay competitive and are able to scale it up to continue serving our customers? And our conclusion was, we do need capital, but we need growth capital. We don't need VC money. We're a profitable business. We've got customers. We've got proven products. We're a sort of global team with offices in multiple continents. And so it's different kind of money that we need. But at the same time, we're not in the league where we need to raise $100 million. We're sort of in a league where we might need to raise $5 or $10 million. So we found ourselves at an interesting crossroads. And when we started talking to potential investors, we started to get offers that ranged from minority stakes all the way to complete acquisitions. And it sort of demonstrated to us how rich the market is in terms of capital alternatives, especially in the United States. And it's really up to us as to which path we go down, and every path comes with its own pros and cons. So that was pre-COVID. Like I mentioned before, we did okay through COVID in spite of the fact that the industry was having a tough time. We saw a pickup in demand for our software because of the challenges the industry was facing and the need for technology to be deployed. And so we started to receive, again, sort of inbound interest early part of this year. And then we decided to move ahead with Riverside, which is the fund behind Unifocus. And that transaction, again, I think what it does today is it gives us the platform to sort of really go out and own the hotel operations space, of which we're a part, but we now have the financial backing and the sort of global scale and size with Unifocus and Knowcross put together to be able to really pursue that ambition. So, anyone coming into this space is going to sort of have to meet certain criteria, especially if they want to work with the larger customers. And if you really talk of sort of bigger customers who control a disproportionate share of potential revenue for companies in this space, we've got to understand that those customers right at the top will have security as their number one requirement. They'll have to be guaranteed SLAs on support and software and its quality and so on. And those customers need the size and heft of a well-capitalized vendor to be able to consider them seriously. So while there's a lot of competitors who keep jumping into the space, the reality is that they find it harder to compete for the bigger blocks of business. And they, and of course they'll take away the sort of lower paying customers, the customers in their local geographic area, etc. So I think for us it was a fairly clear choice as to what the future of the business, what we want it to be, and the fact that it's only going to get there if we have sort of the financial backing of a fund. And of course, with what we got eventually with the transaction that we did is we got the advantage of sort of being put together with a company that's very complementary to us as a business, both in terms of geography and in terms of products and skill sets that they have. And so when we put both of these together, actually what we get is not just a business that is able to take on the hotel market, which we're both in quite, and have a good presence in, but it's also going to be able to take on, go after markets in other service businesses. So healthcare is one in which we both have some penetration already, although limited. Restaurants is another one. Retirement communities, senior living, cruise lines, these all become very viable target markets for us as a combined business.
Nikhil, thank you for taking the time to share your insights today. I wish you all the best on your acquisition and the integration of that and the future growth of the business, but more than anything else, great to hear your insights about how you've evolved the business over the last 20 years or so and tackled some of the challenges that you've been faced with over the last couple of years. So very much appreciate you sharing your insights today, and I wish you all the best.
Thank you, Russell. My pleasure.